legacy planning. It sounds like something only old money families whisper about over brandy. But here you are, staring down a life insurance decision that could define what your name means for generations. And the stakes are not small. We are talking about the difference between leaving your family a fortress or leaving them a fixer-upper with a leaky roof. So let us unpack the real question on the table. Should you go big with one massive permanent life insurance policy, or stack a series of smaller permanent policies loaded with riders like a Swiss Army knife of financial protection? On the surface, it sounds like asking whether you want one giant pizza or several smaller ones, but the toppings, the timing, and who gets fed actually change everything. There was a moment not long ago when the financial world was almost evangelical about whole life insurance, as the ultimate legacy vehicle advisors were practically handing out brochures at baptisms. But then interest rate environments shifted, the index universal life space exploded, and suddenly the clean narrative of just get a big policy started showing some cracks. The behavioral reality is that most people do not think about legacy planning the way actuaries do. They think about it emotionally, reactively, usually after a funeral or a health scare. That psychological entry point matters enormously, because a policy you actually keep and fund consistently for 30 years beats a theoretically superior policy you lapse in year 12 because life got complicated and premiums got tight. Here is the mechanical truth that most agents gloss over. A large, single, permanent policy gives you simplicity, lower cost per unit of death benefit, and one clean story to tell your estate attorney. Smaller stacked policies with riders give you modularity. You can drop a policy if cash flow tightens, layer in chronic illness riders, long-term care riders, return of premium structures, and essentially build a financial Swiss Army knife that adapts as your life does. History actually has something instructive to say here. Wealthy families in the early 20th century used tiered permanent insurance structures, almost like private banking systems, and the Rockefeller family's legendary use of whole life as a tax-advantaged wealth transfer tool is basically a case study that insurance nerds still cite at conferences with suspiciously high levels of enthusiasm. But here is the irony. Most people who invoke that strategy are not operating at Rockefeller scale. And a strategy designed for 9 figures can look very different when you are working with a $250,000 death benefit. The misconception we need to demolish right now is that bigger always means better in legacy planning. That is simply not true, and it is costing families real money. A large policy with a lapsed premium schedule is worth exactly $0, while 3 modest paid-up policies with an accelerated death benefit rider can be a lifeline if you get seriously ill 20 years before you planned. Riders are essentially the plot twist that most people ignore when they are dazzled by the headline death benefit number. A chronic illness rider alone can convert your death benefit into living benefit dollars if you need long-term care, which statistically, there is roughly a 70% chance you will. Ignoring riders when shopping, permanent life insurance is like buying a smartphone and refusing to download any apps you have, the hardware, but none of the functionality. From a pure legacy architecture standpoint, the practical lesson history teaches us is this: diversify your policy structure the same way you diversify your investment portfolio. One large policy concentrates your risk into a single contract, a single carrier's financial health, and a single premium obligation, while a laddered approach spreads that exposure and gives your heirs more optionality. The disciplined move here is not the flashiest one. It is sizing each policy to what you can fund without strain in a bad economic year, not a good one. Conviction about your legacy goals means nothing if you're making emotional, oversized commitments that force a lapse when the market drops or the business hits a rough quarter. What we are really talking about is process over prediction. You cannot know whether you will live to 65 or 95, whether tax law will change, or whether your family dynamics will shift in ways that make a trust more appropriate than a direct beneficiary designation. Building flexibility into your policy architecture now is not hedging. It is just being honest about uncertainty. The philosophical through line here is that legacy is not built in a single dramatic gesture. It is built in the mundane, consistent, unsexy act of keeping your premiums funded, reviewing your beneficiaries annually, and making sure your policies are actually aligned with your current estate documents. The family that wins generationally is not the one that made the boldest bet in year one. It is the one that stayed in the game for 40 years without blinking. And here is the part nobody frames this way. Being comfortable with either outcome, whether you outlive your policy's sweet spot or pass earlier than expected, is itself a form of financial maturity. Rational preparation means your family never has to scramble, never has to negotiate, never has to wonder what you intended, because you built a structure that works regardless of when the story ends. So whether you land on one well-structured permanent policy or a tiered portfolio of smaller ones with strategic riders, the real answer is the one you will actually maintain, fund, and review, not the one that looks best on a napkin calculation at a dinner with your insurance agent. Discipline, sizing, and consistency are not the exciting part of this story, but they are the whole point. And if you are ready to take the next step, whether that means building a legacy plan, investing in real estate, tackling a home renovation project, or finding the right lender to make it all work, check out our links in the description below and let us help you get started.